If you're thinking about buying a home for a parent or for an adult dependent child who cannot qualify for a mortgage on their own, there's a part of conventional lending rules that is easy to miss unless someone points it out to you. Most buyers assume that if they're not the one living in the home, the loan automatically has to be treated as an investment property. And that usually means a larger down payment and a higher rate, and in some cases, it puts the purchase out of reach altogether. Under Fannie Mae's current guidelines, there are limited situations where a buyer can purchase a home for a parent or a disabled adult child and still be treated as the owner-occupant for mortgage purposes. That classification matters because it changes how the loan is priced, how much cash is required up front, and how the file is underwritten. This is not something that most people learn from a headline or a listing agent. It comes up when a family is trying to solve a real housing problem and realizes the rules are not as simple as they assume. In this video, I'm going to walk you through exactly what Fannie Mae allows in 2026, who this applies to, how lenders document occupancy, and what you should be thinking about before moving forward. The goal here is clarity, not persuasion. I want you to understand the structure so you can decide whether this fits your situation and have a smarter conversation with your lender before you even write an offer. This idea does not come from marketing language or lender discretion. It comes from Fannie Mae's selling guide, which is the set of underwriting rules that lenders have to follow for conventional loan. Inside those guidelines, Fannie Mae outlines a few narrow family situations where a buyer can still be treated as the owner-occupant even though they are not the person living in the home. Two scenarios are spelled out very clearly. One involves parents or legal guardians buying a house for an adult child who is disabled and cannot qualify for a mortgage on their own. The other involves children buying housing for parents whose income or work situation makes it unrealistic for them to qualify by themselves. In both cases, Fannie Mae allows the buyer to be treated as the owner-occupant for lending purposes. And that classification is what reshapes how the loan is priced and how the file is evaluated from the beginning. That owner-occupied label carries real weight in lending. Every mortgage is placed into one of three categories: primary residence, second home, or investment property. Each one comes with its own pricing, reserve requirements, and risk adjustments. Investment properties usually involve higher down payments, higher interest rates, and extra pricing hits built into the loan. Second homes have their own restrictions as well. Primary residents are treated more favorably because the borrower's financial connection to the property is different. That's what makes this family purchase exception meaningful. When the scenario fits, Fannie Mae allows the loan to be underwritten the same way a primary residence would be, even though the buyer is helping a family member live there. This is not a broad rule for buying homes for relatives in general. It applies only to a very specific situation. The person living in the home must be an elderly parent or disabled adult child who cannot reasonably qualify for the mortgage on their own. It does not extend to siblings, cousins, friends, vacation homes, or rental arrangements for family members. The key factor is not the relationships by itself, it's whether the occupying family member would be able to qualify independently. This is what makes the occupancy exception possible in the first place. Even when the family relationship qualifies, the home itself still has to meet Fannie Mae's normal property standards. The property must be located in the United States or certain U.S. territories. It has to be suitable for year-round use, legally permitted, and structurally sound. Zoning rules still apply. The number of units must fall within Fannie Mae's 1 to 4 unit limit. Group homes are addressed in the guidelines as well, and they are not automatically disqualified, but they do receive closer review depending on how the property is structured and occupied. When the living arrangement is more complex, lenders expect additional documentation and analysis before moving forward. Because the loan can be treated as owner-occupied, the down payment requirements are usually far lower than they would be for an investment purchase. Under standard conventional guidelines, many owner-occupied transactions allow as little as 5% down, and in some cases even less, depending on how the borrower profile and loan program used. That is a major contrast to investment properties where 15 to 25% down is common. The exact requirement depends on things like credit history, loan size, property type, automated underwriting results, and just the overall risk factor. For buyers, the important point is this: when the family occupancy rule applies, the loan is generally evaluated under primary residence standards instead of investor standards. Because the buyer is not living in the home, lenders have to be very clear about why the transaction still qualifies as owner-occupied. That usually means documenting the family relationship and explaining why the occupying parent or child cannot reasonably qualify on their own. Income limitations often also play a role. So in some cases, inability to work is part of the picture. Social Security awards letters, pension statements, or similar records are commonly reviewed. When appropriate, medical or disability-related documentation may also be required. The lender will also have to document who will live in the home and how the arrangement is structured. One detail matters just as much as everything else. The buyer must qualify and carry both payments, their current housing payment and the new mortgage payment. Fannie Mae does not allow the occupying family member's limited income to replace the buyer's ability to afford the loan. The buyer has to stand on their own financially. This structure does not bypass underwriting. The buyer still has to meet standard conventional requirements for credit score, debt-to-income ratios, employment history, asset verification, and reserves when applicable. What changes is the way the property is classified. What does not change is the need to qualify. That is why timing matters so much. These loans work best when buyers talk with the lender early before writing offers, so the structure is set up correctly from the start rather than adjusted later. Without this rule, buyers often end up looking at second home financing, investment loans, co-borrowing, or co-signing arrangement. Each one can work in the right situation, but each one comes with different trade-offs. Second homes usually involve distance rules and personal use requirements. Investment properties bring higher rates and larger down payments. Co-borrowing means everyone in the loan still has to qualify. The family occupancy exception exists for a specific reason. It is designed for situations where the buyer is providing housing, the occupant cannot reasonably qualify for on their own, and the property is intended that is the family member's primary residence. Most buyers never come across this option because it lives inside of technical underwriting rules rather than marketing materials. This is often described inconsistently online, and only a small group of families actually qualify. That is exactly why learning about it early matters. Used correctly, it can open doors for parents or adult children who would otherwise struggle to buy. Handled incorrectly, it can create friction late in the process when underwriters start asking questions. Fannie Mae allows owner-occupied financing in a very specific family situation when the occupant cannot qualify independently. That structure often leads to lower down payment requirements and better pricing than investment loans, but the buyer still has to qualify financially. The property still has to meet standard eligibility rules. The family relationship and living arrangement must be documented clearly, and this is something to explore with the lender early, not after an offer has already been accepted. If you're thinking about buying a home for a parent or an adult child and want to know whether this rule applies to your situation, use the link below to book a call with my team and we'll walk through it carefully. And if you want straightforward explanations about how lending actually works in today's market, make sure to hit that subscribe button. My goal is to give you clear, accurate information so that you can make informed home buying decisions and ultimately win with Wade. We'll see you in the next one.